Hey everybody, welcome back to Grain Markets and Other Stuff. Thank you for joining me. It is Sunday morning. We have tomorrow, which is Martin Luther King Jr. Day off in the grain markets. And I was running through just a few charts here this morning, trying to get ready for my newsletter on Tuesday morning. I do a little bit of prep over the weekend typically. And I was looking at the fund positions in the grain markets, and I figured I would go back and discuss just the position in the corn market specifically, because it's really phenomenal what's taken place here, not only recently, but over the course of the last 6 or 7 months. So this is going to be a quick review, and I'll give you my 2 cents on the situation. Remember, guys, if you're watching on YouTube, hit that like button if you like the content. Make sure you subscribe. That would really help me out in regard to YouTube and their algorithms. Helps me to spread these videos out a little bit more. If you're listening on the podcast, thank you for listening. Make sure you leave me a review, and make sure you subscribe to be made aware when new content is available. To get right into this here, I want to go quickly and talk to you about the definition of managed money or the funds. I know that people hear about, in the grain markets, people talk about the funds and how the funds are long the market or short the market or whatever. And I'm not sure that the understanding of who the funds are is necessarily that great. So this is the definition off of the CFTC website. Managed money trader, MMT, a futures market participant who engages in futures trades on behalf of investment funds or clients. While MMTs are commonly equated with hedge funds, they may include commodity pool operators and other managed accounts, as well as hedge funds. So that's the definition of what we're talking about when we talk about the funds or managed money. These are large speculators, some sort of fund, whether it's a hedge fund or a commodity pool operator, whatever. And the big thing here is that these big funds do not have a position in the physical market. They're not hedgers. These are speculative traders. They're simply speculating on the markets. They don't have a position in the physical market. Those large traders who have positions in the physical market, we'd refer to as commercials. Those are like your ABCDs or grain elevators or whoever, people who have positions in the cash market. Those are hedgers. Managed money, who we're talking about here, these are large speculators, large funds, hedge funds, commodity pool operators, that sort of stuff. So these are large speculators. And remember, guys, I know that most people know this, but the futures market is what we call a zero-sum game. For somebody to make $1 in the futures market, somebody else has to lose $1. So I always get this question, and it's often phrased this way. People will say, is the market long or short? And that's not a question that I can answer, because for every long in the market, there is a short. So when we talk about the funds, we're talking about just this segment of traders. And there are other positions in the market that totally offset and are opposite of what these large speculators have in the market. But I figured I would explain that real briefly. And if you have follow-up questions to that, drop a comment in the YouTube video, or you can shoot me an email to info@standardgrain.com, and I could explain it to you in a little bit more detail. So the chart I'm going to show up on my screen here, this is the net fund position, or the net position of managed money in the corn market, dating back to like 2007. And that was kind of when they began what we call the modern era of record keeping in regard to CFTC and the corn market. As of last Tuesday, which was January 12th, I believe, fund traders, large money managers, this is the futures only version, by the way, for you CFTC scholars out there. Funds were net long 360,000 contracts of corn as of last Tuesday, and it was estimated that late last week, funds bought an additional like 40,000 contracts, which puts them at Friday's close they're estimated to be long about 400,000 contracts. And what you can see from the chart here is that if that 400,000 were confirmed, that would be very, very close to a record long position. The record long in this modern era of record keeping was in 2011. Funds were officially long 409,000 contracts in March of 2011. So we're getting very close to record length here, if these private estimates are anywhere near reality. And they've been very off as of late. When you get into these lofty price levels and you see more volatility, it's a little bit trickier, I think, to gauge where the funds are at. But in any case, they're very heavily long. They're close to record long in by most estimations. So that in itself is interesting, that large speculators are essentially the most bullish the corn market that they've ever been, barring that period in 2011. Um, what's even more surprising and interesting and phenomenal to me is the way in which this happened. If you go back to this point on the chart down here, this was June of 2020. On June, it was like mid-June 2020. Funds were net short. They were net short 302,000 contracts in mid-June of 2020, just this last year. We're talking 7 months ago. That was at the time, and still is, I guess, basically the second largest net short position on record. So in that time, from mid-June of 2020 to last week, funds were net buyers of 700,000 contracts of corn over the course of like 7 months, which is really phenomenal. We've never seen a swing like that. It is interesting to note that we saw something similar but less dramatic in 2019. In 2019, funds were record short corn in April. They were short 344,000 contracts, and then they very quickly flipped that net short to a net long of 178,000. So they flipped over 500,000 contracts at that time, which was very impressive. So we've even gone above and beyond that here with yet another massive swing from 2020 into 2021. This is interesting for a number of reasons. In regard to grain marketing, and I know that a lot of people out there listening are farmers. In regard to grain marketing, I like to use this data as one of several marketing tools. And what I typically like to do is I like to really try to avoid sales if I see that large speculators are super heavily short, because when funds are super heavily short, that typically means that the market's kind of down and out. And of course, very simply, we're interested in selling high and not selling low, right? If we're talking about marketing cash grain. So I try to avoid sales when funds are very heavily short, and I try to do my marketing typically when funds are long to heavily long, and we've been in that situation here for a long time now. I mean, funds have been long or what I'd consider to be heavily long since mid-October. So it's not like this is the only indicator that you can use, but it's one indicator that I like to use. So that's something to keep in mind is that in many situations, your best marketing opportunities will come when the funds or large money managers are long or heavily long. I guess the other thing is like the question, why did this massive swing in sentiment occur in such a short period of time? And the answer to that is something that we don't really know. You got to keep in mind that the funds are a group of traders that are not related. It's not like all the funds talk to each other every weekend about their position. I mean, maybe they do, but I don't think they do. But the change in sentiment here is phenomenal, and it happened, in my opinion, for a number of different reasons, and this is all opinion based, but we saw a massive shift in the supply-demand situation, or the perceived supply and demand situation, from say last summer through these first couple weeks of January. Last summer in May and June, USDA was projecting these phenomenal stocks of corn, this massively burdensome supply and demand situation, and things just looked really, really, really negative at the time. Fast forward, we ended up with a light crop in the U.S. in 2020. We ended up with some phenomenal export demand that was above and beyond what anybody thought was possible. We did have some demand struggles as well. Ethanol continues to struggle, and that's a totally different conversation. But the situation changed drastically from a fundamental standpoint, just when it comes to pure supply and demand. The other thing that changed, in my opinion, was COVID and the government stimulus that came out of COVID. And a lot of things changed when that first stimulus bill was signed back in late March. We saw the U.S. dollar reverse trends. The U.S. dollar had been trending higher ahead of that stimulus and quickly reversed and began to trend lower in late March when that first stimulus was signed. We saw commodity prices as a whole. If you look at like the Goldman Index, the Bloomberg Index, they essentially bottomed about the same time that first stimulus bill was signed and started to trend higher. You saw the stock market, your S&P 500, your Dow, your major indexes, they bottomed around that time that the stimulus was signed, and they began to trend higher. So I think that the weaker dollar, the maybe fear of inflation has caused part of this. I think that it's partially responsible, in my opinion. I think it's partially responsible for the massive shift in sentiment. You got to remember that if you're afraid of inflation, or you're afraid of a weaker dollar, commodities, being a long position in the commodities market is kind of a hedge against that in a roundabout way. And we've seen this in past instances where the dollar has weakened. If you go back to, say, 2007 or 2008, we had a very weak dollar during that time frame, also following a big government money printing type scenario. And we saw a similar deal. We saw a big spec run up in the corn market and a number of other commodity markets. That was back in a different world when crude oil was at $140. But the big shift in sentiment here has happened, in my opinion, for a few different reasons. I think supply and demand has a ton to do with it. We're in a much, much tighter situation in regard to corn here in the United States, especially, than we were back in say, May or June. And I really think that just the world has changed in terms of the value of the dollar, fears regarding inflation, and that sort of thing. So there's a number of things that have caused this big change in sentiment. I mean, we went from essentially large speculators holding the second most bearish position ever back in mid-June to now holding almost the most bullish position ever. So as it stands here this morning, I mean, the funds are obviously really friendly to the market. They're set up that way. Again, these are large speculators that do not have a position in the cash grain market. They're not hedgers. They're large speculators, and they are extremely heavily long here, again, because of a tighter supply and demand situation. I think, in my opinion, if I had to guess, because we've got a weaker dollar, because there's some inflationary type stuff going on. But that is all up for debate. The reasoning is up for debate. I can't go and interview every fund trader and ask them why they're long. All we know is that they're long. Why they're long is a question that cannot be answered with any sort of guarantee. We can only speculate on that. So I figured I would just give you this quick update here this morning. I hope this was useful to you. Remember, guys, if you need some more information from me, go to my website. It is www.standardgrain.com. Go to that website, click on Grain Marketing Plan here in the upper right-hand corner. For $49 a month, I will send you my morning email, which goes out every business day at 6:30 Central Time. I'll send you my text message service. I will let you know exactly when, how, and specifically I'm pricing corn, soybeans, and wheat throughout the year. So certainly check that out. Everybody have a great weekend. I will be back with my normal morning routine on Tuesday.